Welcome to the Strategic Auto Loan Play. In this video, we will explore how accepting a slightly higher dealer APR in exchange for a large upfront discount can reduce your total cost of ownership, and how to quickly refinance to reclaim a lower rate. Now, let's outline what we'll cover and then dive into the method step by step. In this agenda, we will cover the core strategy, demonstrate the math with examples, visualize the decision in diagrams, and show you a practical step-by-step plan to execute within 60 to 90 days. We will also debunk common myths about fees, credit scores, and debt-to-income ratios. Finally, we will include quizzes to test your understanding and a clear disclaimer about reading the fine print. Next, let's define the strategy clearly. The reason this works is that large upfront discounts directly reduce the principal, which is the base on which interest is calculated for every month of the loan. A marginally higher APR over a short initial window often costs less than missing out on a substantial principal reduction. By refinancing quickly, you can lock in the discount but shed the more expensive dealer rate. With that foundation established, let's spell out the step-by-step strategy. Here is the short version. First, you negotiate the vehicle price as usual. Next, see if the dealership offers an incentive, such as $2,000 off, if you finance through their captive lender. If that incentive is available and the dealer's rate is only slightly higher, accept the dealer financing to capture the upfront discount. Then, plan to refinance quickly, ideally within 30 to 60 days, or right after any contractually required lock-in period. Throughout this process, check the contract for any prepayment penalties or lock-in clauses. The underlying logic is simple. A significant reduction in principal usually outweighs a small APR difference, especially when you will not keep the higher rate for long. Now, before we go deeper, let's add an important disclaimer. Disclaimer: this video is for educational purposes only and is not legal, tax, or financial advice. Loan terms, credit policies, and consumer protection laws vary by lender and jurisdiction. Always read your contract, ask the dealer to point out lock-in periods and prepayment terms in writing, and consult qualified professionals for your circumstances. With that caution in place, let's visualize the decision flow that guides this strategy. This flowchart shows the logic. Start with your negotiated price. Then check for a dealer incentive that requires using the captive lender. If there is no incentive, simply take the lowest external APR available. If there is an incentive, accept the captive financing, but immediately review the contract for any lock-in or prepayment penalty. If there is no lock-in, or only a short one, plan your refinance around 30 to 60 days. If there is a 90-day lock-in, schedule your refinance for right after it expires. The outcome is that you keep the upfront discount and subsequently enjoy a lower APR, reducing your total cost. Next, let's walk through the timeline with a sequence diagram. This sequence diagram lays out the timeline. First, you negotiate with the dealer and accept captive lender financing to capture the incentive on day 0. Between days 1 and 15, you review the contract thoroughly, focusing on any lock-in period and prepayment penalties. Between days 15 and 45, you rate shop and secure pre-approval from a credit union or external lender. You make 1 to 3 payments to the original lender, satisfying any contractual lock-in. Then, between day 30 and day 90, you complete the refinance. The credit union pays off the original loan, the captive lender closes the account, and you begin payments on the new lower rate loan. With the process understood, let's run the numbers with a concrete example. Here is an illustrative comparison using approximate calculations. Scenario 1. External lender only at 5.49% APR for 60 months on $30,000, results in an estimated payment of about $571.88, a total paid of approximately $34,312.80, and total interest of about $4,312.80. Scenario 2. Dealer captive financing for the full term at 6.49% APR, but with a $2,000 incentive reducing principal to $28,000, yields an estimated payment of about $547.33, a total paid of roughly $32,839.80, and interest of about $4,839.80. Scenario 3. Take the dealer incentive, make roughly 2 payments, then refinance to 5.49% for the remaining 58 months. That produces an approximate total paid of about $32,147.28 and interest near $4,147.28. These figures are rounded and for illustration only. Actual rates, amortization schedules, fees, and timing will change outcomes. Next, let's visualize the cost composition with a quick chart. This pie chart provides an intuitive snapshot of the illustrative refi path. The largest portion is still principal, which is reduced by the dealer incentive. Interest is a smaller share due to refinancing to a lower APR early in the loan. The savings slice reflects the difference versus proceeding without the incentive. This is a conceptual visualization rather than an accounting statement. Now, let's convert the strategy into an actionable checklist you can follow. Follow these steps. First, secure a pre-approval from a credit union so you know your baseline APR. Next, negotiate the vehicle price and ask explicitly about captive finance incentives. If the incentive is meaningful and the APR difference is small, accept the dealer financing to capture the discount. Before signing, verify in writing any lock-in period or prepayment penalty. If permitted, schedule your refinance in 30 to 60 days. Otherwise, plan it for immediately after the lock-in ends, which is often around 90 days. When rate shopping, keep your applications within a short window, because many scoring models group auto inquiries within 14 to 45 days. Then complete the refinance and ensure any fees do not erase your savings. After refinancing, consider applying a small extra principal payment to accelerate amortization. Finally, monitor payoff confirmations and verify the original loan is closed. Next, let's address common myths by comparing them to the facts. Let's compare myths and facts. First myth: refinancing fees will wipe out any savings. In practice, standard auto refinance fees are often nominal and typically much smaller than the savings you gain by lowering the APR, especially over the remaining term. Second myth: rate shopping destroys your credit. Many scoring models treat multiple auto loan inquiries within a 14 to 45 day window as a single event, limiting the score impact. Third myth: a higher debt-to-income ratio automatically disqualifies you. For standard auto lending, strong credit history and demonstrated positive cash flow can outweigh DTI concerns, particularly for borrowers with 800-plus credit scores. Now, let's check your understanding with a quick quiz. Question 1. On a $30,000 car over 60 months, which usually saves more overall? Option A, 0.25% lower APR with no incentive. Option B, a $2,000 upfront discount with a slightly higher APR and then a quick refinance. Option C, skipping both and paying cash later. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. A substantial upfront discount reduces the principal on which interest is calculated. After a quick refinance to a lower APR, you eliminate most of the cost of the initial higher rate. This combination typically results in a lower total cost of ownership compared to a marginal APR improvement without the incentive. Next, let's reinforce the concept with a bit of markdown and a simple formula. This section provides a simple mathematical checkpoint. The monthly interest rate equals the APR divided by 12. The standard amortized payment formula is payment equals R times present value divided by 1 minus 1 plus R to the negative n. The key idea is that if present value drops by $2,000 due to an incentive, the total interest paid over the term decreases because interest accrues on a smaller base. When you then refinance, you hold the higher rate only briefly and switch to a lower rate for the remainder of the term. Now, one more quick quiz to make sure the fine print is top of mind. Question 2. Before planning a refinance, which contract items must you confirm? Option A, a lock-in or minimum payment period. Option B, prepayment penalties or any incentive clawback provisions. Option C, both A and B. You may pause the video now to consider the answer. We will discuss the answer in the next section of the video. The correct answer is C. You must confirm both the lock-in or minimum payment period and any prepayment penalties or incentive clawback clauses. These terms determine when you can refinance without losing the incentive or incurring extra costs. With those checks in place, let's close with key takeaways. These are the key takeaways. First, large principal discounts often outperform small APR improvements. Second, refinance within 30 to 90 days to retain the discount and remove the higher dealer rate. Third, verify lock-ins and prepayment penalties up front. Fourth, Cluster rate shopping within 14 to 45 days to minimize credit score impact. Finally, strong credit and cash flow can offset debt-to-income concerns in standard auto lending. Now let's summarize the entire play in a few concise points. In summary, negotiate the price first, and then leverage captive financing incentives when the numbers favor you. Accept a slightly higher APR, only to capture a large upfront discount. Refinance quickly, once any lock-in period has passed, to secure a lower rate. Verify fees and terms so your savings are real. For strong credit borrowers, this approach often reduces total cost of ownership. Finally, let's conclude with a friendly request. Thank you for watching. If this video helped you, please like, share, and subscribe. We invite you to share your questions and your experiences with dealer incentives and refinancing in the comments. Your insights can help others make smarter decisions too.